What is up? What is up? Hello, hello, my favorite people. How are we? Keith, how are you?
Let's go. I'm fantastic, Ben. How you living?
I'm honestly, man, this is the best day of my life.
Oh, no way.
I hit you with it. I hit you with it. What up to in the
I
chat? Say what
love
up,
it.
say what up. We got Chad here. Let's get it. Absolutely, Chad. Let's get it.
Let's
If you're
go,
here, say
Chad.
hello. Do not be shy. We have a guest popping in the stream who is a legend, who is just a little bit late. So we will be going live as soon as he hops in here. So Bryce is our guest today. He is an expert in the VC world. So VC stands for venture capital. It's a way to get yourself funding for your business to get your idea off the ground. It's really become very popular from places like Y Combinator, A16Z. Who else am I missing? Sequoia, yeah. So it's become very popular, and a lot of entrepreneurs, their dream is to be VC funded. And so who better to talk to than an expert? Yeah, Rob says, oh, Ben steals the line. Yeah, I definitely had to. He gave it to me. I had to take it. Flexo says, what up? Hola. That kid, what up? What up?
The
Cross
whole point
Central.
is that everyone ends up saying that. You know, you just
Totally.
got a circle of people that just spread that to the world.
What up? What up? What up? Say hello.
I guess like one of the things that I could start to jump in on a little bit too is like where VC sits in uh, the whole world of capital, because basically the one thing about venture capital firms that I think can sometimes be misunderstood is that it's just another form of private equity, right? So when it comes to investors who are wealthier or whatever, when they're looking for places to put their money, there's different options, right? You always have the public markets, you can go and invest in stocks, and then you also have private markets where you can go and invest in specific companies, right? If you want to invest in startups and be an angel or whatever in that way. And then you can invest in private equity companies or private equity firms where they go out and specifically raise money to go and invest in specific types of companies. And then venture capital, which is just really a subset of the private equity world, where you have a manager who's managing the fund who gets paid a fee the same way that a private equity manager would. And their goal is just a very specific type of company, which is a startup, right? Is what they're investing in. So it's a private equity firm that goes out and invests in startups. So I just want to kind of explain that a little bit to our audience.
Super important. Yeah. Base level knowledge there. And why would a VC firm exist? It's because if they get it right, it is incredibly profitable because they come in from the ground floor. And so naturally, they're also taking on the highest degree of risk. But in an age of exponential companies, the returns can be absolutely crazy. And because the multiples that they get on their investment, if it does work out, they're so insane that if you hit on 1 out of every 100, you're still making some pretty good money in a lot of cases. So it depends obviously on how the fund is run, how much money they're putting in, all this different stuff. But the returns that good VCs get is absolutely absurd.
Yeah, and you also made a good
Bryce.
point of like even okay.
Yeah, what's going on? Can you hear me?
What up? Yes, sir. Yes, sir. How you doing? How you doing? Meet Keith. Keith, meet
Nice.
Bryce.
What's going on, Keith? How are you?
What up, Bryce? Today's the best day of my life, man. How you living?
Cannot complain. God is good.
That's it.
Excited to be on the show with this GOAT Ben, man. Known him for a little bit, so it's cool to be on the show. Apologies for running a little bit late.
You're good. You're good. It's all good. We were just giving the audience some background on what VC is in general. We figured we'd wait for you to give the context on who you are. But yeah, so
yo, your camera is crazy. What are you using right now?
Me?
Yeah,
it's a Sony A6400 with a Sigma lens.
Damn, I'm like, I need to get mine like yours. I thought I have a ZVE1, but my quality not looking crazy like that. I might need a new lens.
No, yours looks good, but the lens would help you out for sure a little bit. But I think yours looks fantastic. But yeah, since Keith hasn't met you before, can you give us like the elevator pitch in terms of who you are, how you got to where you are, kind of thing?
Yeah. So my name is Bryce. I go by Brycent on the internet. A content creator. Started out in the crypto space and raised money for a company back in 2021. We were building at the intersection of crypto and gaming. Unfortunately, it did not go well, as most things in Web3 gaming have not. But continued making content after that, and more recently decided to jump back into kind of the venture and startup space and focus my content on venture startups. Started that about 6 months ago. I think I've scaled up like 70,000 followers since then, just all focused in venture and startup content. So it's been a bit of a crazy run. And yeah, this is where we are today. I'm building my own media company and investing in startups, and eventually I'll launch my own venture fund at some point. But right now it's like all hands on deck scaling media and growing the brand.
Perfect, man. Keith, what comes off of that? I'm sure I already have 100 questions, so I'll let you go first.
Yeah, I mean, I watched some of your content from maybe a month or so ago, and you talk a little bit about the importance of actually going after media as an entrepreneur in general. Can you talk a little bit about like what the strategy is around why, with the future of trying to raise a venture capital fund or maybe even deploying your own capital, why go after the media?
Well, most funds traditionally have just been kind of living off the idea that like they're either, you know, someone who's a former founder or they were an early employee at a big company. And this is kind of pre-media era. Um, Funds were really, the focus was, hey, we have capital, we can deploy capital, and we can provide you with some sort of like advisory or, you know, just help, right? Like they're not gonna go run the company for you. But traditionally, funds have been very much like, we give you money, we give you connections, intros, those sorts of things. And it isn't as hands-on. But today, you know, everything is very media driven, media related, and audiences are what push a lot of these companies. It's all about community building, brand building, storytelling, and funds from the archaic model that was like 5 to 10 years ago, which was like, we deploy capital and watch you build, but we'll be hands-on in some instances, don't really fit today's go-to-market scope for what a lot of these startups need. So what I realized, right, is, you know, as a former founder trying to break my own way into venture and figure out what this looks like for me, the main goal was, okay, if all of these funds just have money and like that's the thing that kind of sets them apart, if I'm the guy who can provide actual media brand power to startups at a high level, ones that I invest in, ones that I work with, I can be more valuable over time than just the plain Jane fund that says we have money and connections that might somewhat be outdating. You know, audiences are getting younger, so the next wave of entrepreneurs, founders that hit that unicorn revenue mark or become billion-dollar companies, they're going to be younger audiences that don't resonate with older VCs that aren't on the internet, right? So from my perspective, I believe, and I think a lot of people would probably agree with me, that media is probably the most important piece of any kind of emerging fund or anyone who's looking to become a fund manager, because you can just sway so much opinion. Like if people trust you, if they trust what you're saying, you can talk about a product and say, okay, like, hey, this is a product I'm backing, right? Like a lot of my content has just been me kind of just openly talking about my journey and being really honest in the process. And I think that people have resonated with that. And my hope is that LPs, when I eventually launch a fund, will resonate with that as well and see me as kind of like the media arm for how startups go to market at large. So that's kind of like the thesis behind it. We won't know and like completely until I actually raise a fund, which transparently, I probably won't start looking into doing that until later, like probably closer to the end of next year. But I think the media side of it, like the last 5 or 6 months, has been a very good test to see that people outside of Silicon Valley do care about startups. They are interested in finding ways to get exposure or understanding how they work. And also LPs and VCs all want to do media. If you look at it now, every VC is talking about, oh, like here's a day in my life as a venture partner. It's like, brother, nobody gives a damn about you. They care about like, how can the products you are investing in impact their lives? So I've done a very good job, I think, to this point, really focusing on the storytelling behind each product and how it can relate to just normal people.
No, that's the whole thing, man. I think two things. I think audiences are getting younger, like you said. And I also think that even the older people are becoming a lot more social media native, where they
100%.
actually are spending their time there. They're influenced there. And I had this battle, much like I'm sure you have, where the older heads were people who were already there. They fought social media for so long. Like what was what change have you seen? Because I've seen this too, where I've worked with some VCs that would have never even given me the time of day even a year ago, and now we're able to work with them one-on-one. Like what was the change? What made everyone wake up to the reality of the changing media landscape?
So I think the change is a lot of VCs just realizing that they're falling behind in the grand scheme of where venture goes, right? Because at the end of the day, right, you can have $20 million to invest, but if you can't get into the best funding rounds because people don't fuck with you or they don't want you in or they actually don't know who you are, yeah, it's like saying if I could have a strategic investor with 20 mil that's going to invest in me and then also provide me with additional support versus one that doesn't have that, it goes like such a long way. And even if you don't, like, I would argue, even if you don't have any money, like if you don't have any money or experience, if you can get really good at just talking about companies, dissecting companies, and like keeping a high level of authenticity, there's a very good chance you can get a role in venture. And then like, even if you don't like get the role you were looking for in venture, you can still go out and just work at a high growth startup. Because
Totally.
when I started this 5 months ago, like transparently, my goal wasn't to be like running a fund or like launching a fund in the future. It was like, okay, like maybe I can do this venture thing and like I'll get like a scout or associate role. And that'll be, you know, how I kind of like work my way into venture. But the thing that content allows people to do that most people don't understand is you can expedite the process. The
Totally.
same time that it would take maybe a fund manager who starts off as an associate for 3 years and then builds up that Rolodex. And then after that, they decide to go and join a firm as a partner and then do the partner thing for 10 years and then come from there to actually launching their own fund. When you're visible on social media, when you're building up that brand presence, you could go from, I have an idea that I want to start a fund, let me go crush social media for 12 months, to by the end of that 12 months, you don't know who has seen your content. I've had like people who've sold companies for hundreds of millions of dollars reach out. Just yesterday, it's so funny. I was talking about this like AI scouting basketball company, and like a former like NBA player has made like probably over $100 million, like reached out and he's like, yo, this is like really dope. Would love to connect with you and like see if I could chat with these guys. So you never know who is watching your content. And that's why you just have to keep posting, but realize that content is like the shortcut to taking the long way around to getting the outcome you're looking for.
Dude, it's so high leverage. And I love that you said that because the world is so small.
Yeah.
Even as someone who made content about how to grow on social media 7 or 8 years ago, the people that would reach out to me or talk to me was crazy. Like, I couldn't have bought my way into their rooms
Yeah.
or their attention, but then they're messaging me. Like Keith and I talk about this all the time, where if you're fighting making content, like how long are you going to do this? Right? Because like the opportunity, you're still early, which people don't understand. Most people are like, oh, I'm too late. The VC firms that we're talking about here that Bryce works with, they're like just waking up to this now. Some like the richest people on the planet are just waking up to the scope of things. So it's still like not too late. We also have a question here from the stream here from chat where I want to ask. So VC is like a shark on Shark Tank. How would you answer that question, Bryce?
I would say like you're pretty spot on, kid. So a VC and a venture capitalist, I like to call it adventure capitalist because you're just going on these adventures with founders and hope they work out. But basically, let's say you had a startup idea and you wanted to go and see if you can get funding because you think it could be the next 100 million or $1 billion company. VCs just basically say, okay, well, based on the traction you currently have, based on the revenue or lack of revenue you have, we're willing to value your company at XYZ amount and give you XYZ dollars for a certain amount of stake in that company. But at the end of the day, a VC as a whole is just a person who is taking other rich people's money and investing that money for them with the goal of getting a return that would outperform the S&P 500 or other large kind of conglomerate ecosystems. One of the interesting terms in VC that I picked up from another like really successful venture capitalist, Geoffrey Wu, he actually built like a VC fund with Logan Paul and Jake Paul for this specific purpose of like capturing audience and attention, then using that to parlay in the rounds. Like they invested in like Ramp, they invested in OpenAI, like tons of companies. But the whole idea behind it is you really want to focus in on how you can get into the highest value, best startup rounds. And the only way you can do that is through content. But as a VC, your goal is to, say, hey, I think we can outperform other places that you could put your money. And then they go out to a bunch of billionaires and say, hey, can you give me money? So the same way a founder is trying to raise money from a VC goes out and raises money from limited partners or LPs. And these LPs are basically people operating larger funds for billion-dollar investors, like people who own like, absurd companies, like people you probably would never see, but they own like Picassos and Basquiat's and other shit just because like they have so much money, they don't know what to do with it.
Yes.
Can you talk a little bit about that too? Like I assume some of what you're talking about there, like family offices.
Yeah.
Can you describe what that is to someone who's never heard that term or understand anything about that?
Yeah. So the term family office is basically if you had to go look at Kobe Bryant's estate and you would say maybe Kobe has made I don't know, off of all of his stuff, maybe billions of dollars. Well, someone, let's say Kobe had his own family office before he passed, which I'm sure he did. Someone would basically be a fund manager for that family office. And their goal or focus would have to be, can we go and deploy a percentage of his capital and get him X amount of return over X amount of years? So a family office is basically just an in-house capital deployment vehicle for billionaires and very high net worth individuals. So somebody like, I'm sure Elon Musk might have a family office. Like pretty much every billionaire, even if you don't see them or know them, has a family office. But the thing people struggle with is like, oh my God, how do you get in touch with these family offices? I mean, no one's walking around on the street with a big sign that says, hey, I'm the family office for Michael Jackson's estate, and I have $50 million to deploy into, venture funds. So a lot of the times the big cat and mouse game is, how do you find a family office? And then how do you actually get on their radar? Because a lot of them like to invest in these like early emerging fund managers, but it is a process. You got to play the Silicon Valley dance, as we call it, where you're going out, you're meeting people, you're sharing your investment thesis. Like, just to give you like a high level, and I call this like investment arbitrage. If you're like an investor with like little capital or very little capital, meaning you're cutting like anywhere from like $1,000 checks to 10K, one of the best things you can do right now in the market is actually find startup founders that are looking to apply to accelerators. An accelerator is basically like a startup school where they invest in your company. But what a lot of people don't know, and some of the best ways to build an investment track record for venture, is you kind of want to get multiples. Like you want to get multiples on your investment. So an example of this is 3 months ago, I was in San Francisco. I came across this really dope founder. He told me a story. I invested like measly couple $1,000s in his company because I'm just like, all right, bro has an idea. He has no product, no nothing. Like he literally was just on a backpack, quit his job in New York, moved to San Francisco, and was like, I'm going to build this thing. And I was like, all right, I'm going to cut you like a check for a couple $1,000s. A couple of weeks ago, actually like last week, same founder gets into Y Combinator. So I invested in this founder at a 1 mil cap valuation. In terms of like meme coins or crypto tokens, think of valuations in the same. If you invest in something at a 1 mil valuation and it goes up to a 50 mil valuation, you now have a 50x multiple on your investment. Now, it's not as liquid, right? I can't move in and out of that investment initially, but that sort of track record is what you kind of want to build up, because when you're going to talk to a fund, an LP, and you say, hey, like I have a 50x multiple on this, they're like, oh man, like this guy has like very good attention to detail to understanding how do you source early stage founders, right? And that is how you start building up that resume, where a fund would be like, okay, Ben, like you've shown that you've gotten X amount of multiples, X amount of companies you've invested in have gone on to raise hundreds of millions of dollars and they're crushing it. Sure, I'll give you $3, $5, $10 million for your investment fund. So I know it's a lot to take in there, but I try to break it down in a way that was a bit simple for anybody who has like limited experience in venture.
I think that's super helpful. And the question that I have off of that is, if I'm the entrepreneur, in the age of indie hacking, why pursue VC?
So I tell a lot of people, as someone who raised money previously, and I'll get like a little bit detailed. When I raised money back in 2021, I mean, I was easily on top of the world, like #1 in the crypto and gaming intersection of that space. The space was like how AI is right now. Like everyone thought it was going to be the next big thing. And we were raising money. Eventually we closed at $4.5 million. And what a lot of people don't realize is that like, to really want to raise money and understand whether or not you should raise money, you need to decide what game you're playing. If you're playing the Silicon Valley venture game, you are basically saying, I am trying to take a swing for a home run to hit the ball out of the park into the galaxy. But like, it's normally an all or nothing thing. It's either like you hit a crazy home run, or like 90% of these founders, when they exit their companies, they're actually exiting at a loss. Only the 10% that you actually see that exit are at getting some sort of significant gain. Normally it's like you're getting acqui-hire. So all of that equity you have, like if we raised $4.5 million at a $30 million valuation, I own 33% of the company. I'm a paper millionaire at that time, but you can't do anything with it, right? Like it's not liquid. So for a lot of indie hackers, and the way I'm building my own companies right now is I tell people, build as much leverage as possible, unless your idea is so significantly difficult to build that like you need venture funding, meaning you're doing something with space tech, biotech, like absurd stuff. You should really focus on like, how do you just scale an idea that like doesn't need venture funding? Because you could take, I'm gonna be honest, you put $500 on any of these vibe coding platforms, the Replits, the Bolts, whatever the case is, you can scale, whether it's a mobile app, a web app, and start making your first dollar very quickly. One of the things that I would highly recommend, anyone who's looking to like say like, I want to become like a digital entrepreneur, go check out a company called Bending Spoons. They own some of the most absurd apps some of which you've heard of, some of which you haven't. But they're basically like, if you took private equity, but made it like something that just started out with 4 or 5 different developers, and they started just building apps, acquiring apps, and scaling them. That's a better model for most people because, I mean, think about it. If you get to a couple $100K a month in revenue off of your own apps, and you own, let's say 80% of that is just pure profit, like what the hell can't you buy? You can take one check, go buy the Porsche, another check, put the down payment on the house, and just continue scaling whatever you want. A lot of founders don't understand that they don't actually need to go after venture to make lots of money. But if you are playing the venture game, you're playing the $1 billion or bust game. Yeah, you might get acqui-hired at a couple $100 million, but like for an investor, they don't give a damn unless you think and believe truly that the idea you're working on is a $1 billion idea. So I see a lot of founders that will come up to me and be like, oh my God, I have this crazy idea. And I'm like, as someone who's gone through it, I would highly recommend most founders shouldn't go venture initially unless you truly understand the expectation that comes with it.
That's so good, man. And as the VC guy saying that, like that says a lot for sure. I think that nuance really matters here, and that knowing what you're getting yourself into is really, really big. The question that I had off of that is, what is the biggest lie that VCs tell founders?
Oh man, that's a good one. I would say the biggest lie VCs tell founders is in relation to where they are from a product perspective. So like, let's say you're pitching me your company and I'm not interested. One of the things VCs love saying is like, oh, you're too early. Like, come on, like the term too early is just like a basic way of saying, hey, we're really not that interested, but like, we want to let you down in a way that like makes you feel like there's still something here. Another thing that I hear actually quite often is VCs will actually come out and be like, oh yeah, we're an early stage VC. We invest in companies pre-idea, pre-everything. Like you don't even have to have your docs incorporated, but we're so early that we'll invest in you. 9 times out of 10, these VCs, a lot of them do not have the balls to invest in a company pre-seed, pre-idea. And they say that as kind of like, I would say like almost natural selection of like, yeah, maybe they would look at a deal like that. But oftentimes, unless you fit a certain archetype, like transparently, you were an excellent engineer at a Fortune 500 and you like are like trying to do something different because you found some sort of obscure niche problem and you're like, we think this is a crazy B2B idea, or you have the Ivy League pedigree, or you're just like insanely cracked. A lot of VCs aren't going to invest in you pre-idea because we've entered this moment where MVPs without traction in some cases are actually like a negative signal. Like if a founder came up to me tomorrow and he's like building an app that could be vibe coded, like the first version could be vibe coded. And he's like, hey, I want you to invest in my company, be an angel investor. The first thing I'm thinking is like, so you mean to tell me you spent more time on this deck than you did going out and actually seeing this thing could actually make a couple dollars?
Yeah.
Or like if people actually give a damn about this thing. I'm like,
yeah, what does that mean?
You have AI. When I started coding 7 years ago, there was no AI. Like we just had to sit there and figure this stuff out. That's why if you look at a lot of the early companies that like became $1 billion companies, it'd be stuff like, we're building DoorDash, where you can get food right to your door. Technically, that's not a difficult app to build today because AI, you could one-shot that.
Not hard. Yeah.
Right. Like you could one-shot it. But back then, to be an engineer and put all that stuff together, there was like this sort of skill gap. So now the skill gap isn't really technical for a lot of ideas from a software perspective. The skill gap is actually more so your ability to go out and show, I can get distribution, I can get sales, or I can build a narrative that shows that people actually want this thing.
Totally. That's so good. I want to provide some definitions for people who aren't in this world, because Bryce, you and I are in this every day. We talk about this stuff. We say a lot of buzzwords, right? So MVP stands for minimum viable product, guys. So that stands like the least thing that you can do to prove the concept, essentially. Vibe code is using AI tools to perform software engineering. That could be building something from scratch. That could be improving something you already have. It's using the tools of AI to make software engineering substantially easier. Indie hacker is somebody who didn't get funding and is pursuing their business through the practice of what's called bootstrapping for the most part, where you're building something by yourself. You're not taking on external funding. You're using tools. You're being scrappy and you're building it. And then distribution is a term that Bryce mentioned. That's just like eyeballs. So distribution is like awareness, content, people seeing your stuff. So that should bring everyone up to speed.
I appreciate you doing that, because sometimes I'll go on these rants.
I do too,
and
man.
I'll completely like just miss it.
I do too. Keith, do you have any questions off of that?
What do you think are some of the alternative paths that a founder could take to getting capital if they felt like they needed it, but like you said, probably shouldn't go the VC route?
So there is the aspect of starting small, which is like you kind of try to raise the necessary amount of capital you need to get the idea off the ground. And I recommend founders all the time, if you want to go the VC route, but you kind of want to dabble in before you say, hey, I actually want to go try to raise from a VC, you want to try to get angel investors. And basically an angel investor is someone who is willing to put up early stage capital for startups before VCs come in. So basically they're the people, and that's kind of where I sit right now, where it's like, I'm looking for the next interesting startup to throw, $5,000, $10,000 into, and be one of the first checks in. So if it is a great idea, I can get that multiple. But angel investors aren't holding you to the same kind of standard that a VC might hold you to, in terms of like, hey, yes, I want this to be $1 billion company, but I'm not going to breathe down your neck and try to run your business for you. So a lot of startup founders, if like your idea needs 50K, 75K to get off the ground, you probably should just try to go raise money from angel investors. And I have like a lot of videos on my IG and TikTok that show ways that you can get in touch with them, but also just trying to see if you can find like private business investors. Like there was an idea that I looked at not too long ago where someone was like, he was trying to build like almost like pickleball chains, like a chain of pickleball locations. And I was like, it's a cool idea. It's not venture fundable, but you probably could find like private investors that are non-angel or non-VC related that would invest in stuff that might not fit the venture landscape. The problem is most people just think, oh man, I need to get investment capital because I have an idea, and they only look at venture, right? So, I mean, another cool thing, it's a lot harder, but like build relationships with banks. Like it's so underrated because most people like never walk into a bank. But if you can build a decent relationship with a bank or with just private investors who've made a ton of money doing something and like are like, oh man, I want to be a part of someone else's journey to help watch them build something pretty incredible, you can get capital at much better values, better terms than going the VC route. So I would highly recommend like people just try to get creative and understand that banks exist. Yes, it might be a loan, but depending on what you're doing, and if you can show that the business model makes sense, it makes more sense for you to take out that loan and work with a bank than it does to try to go the venture route. Because a lot of companies do this thing where they'll go raise venture funding, but the problem they run into is the idea actually isn't good enough. So they end up being in this place where they might have a little bit of traction, but they raise $10 million at $100 million valuation. And it's like, yeah, to keep scaling beyond that, you got to show significant revenue numbers and be growing at light speed. And a lot of people aren't ready for the expectation of an investor being like, hey, you're not growing fast enough. We don't care anymore. We're not going to pay much attention to you. Go get acqui-hired by this company that's 8 times bigger than you because like it's just not working.
What are some of the terms, by the way, that a VC might bring to a founder that founders don't think about, but that could completely screw them over?
Terms that they could bring. So the first one I would say, I don't know about terms, but I would say more so just along the lines of, and this is actually very good because we are in this kind of bull cycle for AI, is founders not understanding valuation. I think that's like the biggest issue a lot of founders run into. Valuation and probably board seats, right? Like, so when I was building my startup, we were optimizing to raise as much money as possible. Horrible idea. And we also like optimized for like the VC that gave us the best valuation. To be completely transparent, they were like probably one of the worst partners I've ever worked with. even though they gave us the best valuation, best terms, best everything. Versus if I had just gone with another VC that was like offering like slightly better, like slightly worse terms, but like I would say a better support system. I think founders struggle with understanding like, oh my God, I want to keep as much equity as possible. And that whole idea of like, I don't want to dilute myself too much and like give VCs too much of my business. But in the earliest of days, you actually don't need as much equity as you think you need, right? Like if you own 30% of a $100 million company, like you're going to do very well. 2 or 3 or 4 percentage points from 10% diluting 10% to diluting 15% isn't going to change that much. So from my perspective, what I try to tell a lot of founders to do is like, do not try to raise at the highest valuation possible. Yes, I know you want to keep as much equity, but you want to be able to grow into the number. If you raise at a crazy amount, those VCs are going to have the expectation that like, oh, you have it all figured out. You have it all figured out, and you're going to be able to execute upon the expectations of how high your valuation is. So you put yourself in a box, in a bracket where you have little wiggle room or leeway to like screw up. Another analogy that I love using, because I'm a huge like football fan, not just like American football, but like European football, is like you'll notice it when a player signs like a crazy contract. Mohamed Salah at Liverpool is going through this right now. He signed like this crazy contract in the offseason. They're paying him like $400,000 every single week to play football, but he's not scoring this year. So after 6 months of signing this new contract, Liverpool is like, yo, you're not living up to expectations and your contract is through the roof. We're trying to sell you basically. So he basically got benched. They're trying to freeze him out the team, all this stuff. Well, VC, in a sense, even though it doesn't work the same way, the mindset is still similar. You raise at a lower valuation, you get better VCs and mentorship around you. You're going to build a healthier cap table for the long run versus optimizing for valuation. And a lot of times VCs that really, really want into your round, and especially if it's like one of these hot rounds, they will give you higher valuations just so they can lead. But unless you are like a true dog and you know that you can live up to it, a lot of times founders really crumble under that pressure. It happens to a lot of YC companies as well, right? Like, yeah, everyone sees when a company like becomes $1 billion company, like Kalshi, for example. They did Kalshi. Kalshi's worth like $10 billion. YC made a crazy return on that. But there are tons of YC companies that raise at 20, 25, 30 mil valuations, and they're making no money, no revenue, just raising at crazy numbers because they were in Y Combinator, and like that's what you're supposed to do. But the problem that comes in is who's going to give you capital after that? If you raise at a crazy valuation and then you run out of money and you're like, we need to raise more.
You're cooked.
And raise at a down round, you're now the ugly stepchild of venture. Like basically every VC that invests in you is just going to write you off and move on because like you raised at a down round. So I think there is something to say about understanding the expectation that comes with the price tag. And if you cannot live up to that expectation, you put yourself in a very poor situation.
So I assume VC is a pretty small world. If you're a founder who makes these mistakes, will people give you another chance?
So that actually is like interesting because in most cases, if you are a first-time founder and you go through it and you raise money and it doesn't work out, VCs are actually more likely to fund you the second time around because I think the odds or the percentage of it working the second time around is like, it's absurd. It's like you have like a 20% or I think it's like 10 or 20% higher chance of being successful after you've already failed at venture. On the flip side of that, if you're a fund manager and like, let's say I launched a 10 mil VC fund tomorrow. If I launched a 10 mil fund and like none of those companies like panned out, my chances of raising another fund are like virtually zero. So it's like on the fund side, you have very little wiggle room to like screw up. But on the founder side, yeah, the more you fail, the more likely a VC is actually to fund you because you've gone through the moments and the pitfalls that like I'm warning people about right now, right? It's like if I were doing a venture funded startup again, I would never optimize for valuation. I probably would like solely focus on like how can we build a product that's actually making money before going to raise. But a lot of founders, because it's their first time and they've never done it, they just see it as like, oh my God, VC is my only golden ticket to like get money and to like really have a chance at this. And it's like, no, you can just go out and do things. Like you can just go out and start making content and say, I'm going to build a business around this thing and it might pan out. And if it does, go venture when it makes sense. But I think going too soon is one of the biggest pitfalls that I see from founders.
Yeah, it's definitely glamorized, the whole VC thing. It's seen as such an achievement. But ironically, people see it as the end when it's really just the beginning.
Yeah.
Right? Like it's not, you're not there at all. You just signed up for a shitload of work. You know
You
what I
know what
mean?
I never understood is why in venture capital it is funding rounds in venture capital are more celebrated than revenue numbers.
Yeah, that's
You
true.
always see a startup, an early stage startup, mid stage, late stage. They do these crazy videos every time they raise money. Oh, we raised $10 million to build the future of super hyper intelligent sonic, supersonic boom, yada yada, whatever buzzwords you want to put in. But when it comes to actual product and revenue, you never see these like crazy videos. And to me, that's what should be flexed. Like if you made 100 million in revenue this year, you know what I want to see? I want to see a launch video where y'all are, I don't know, out in Fiji. You and the core team is in Fiji and you're celebrating. It's like we had 100 million in revenue and decided to take our team on a team bonding trip for the next month. I don't know. Do something that is in relation to we hit an actual milestone that is revenue generating instead of debt accruing. Granted, like VC is not really debt, but like raising money to me isn't an accomplishment anymore. The real accomplishment is building the product and building something generational that people want to use. And we need more of that in VC.
Keith, do you have a question? Looks like you're deep in thought.
I mean, the one thing that you just touched on that I want you to explain further around, like you said, VC is not really debt, but in a lot of ways, VC performs that form of equity looks a lot more like debt than typical equity. Can you break that down a little bit?
So I see VC as, and this is why it's always about like towing this fine line. VC can be good or bad debt, but the debt isn't in relation to you owing somebody X amount of dollars that you have to pay back at interest over X amount of years. The reason why I say VC can be good or bad debt is because imagine if you spent 3-4 years working on a company, you raised 5 funding rounds, however many funding rounds you raise, and your company's valued at $200 million. Another company comes out of the blue and is just like crushing it. You guys somehow stall out and like you end up selling that company for less than the valuation or at the valuation that the VC's invested in. You now get no money, but you spent the last 4 years of your life building something without any takeaway other than I got experience building a startup. Let me go again. And a lot of founders will like kind of fall into this loop of like, oh man, VC is the greatest thing ever. But you truly have to understand that as a founder, if I go out and raise at a $200 million valuation and I sell the company for $300 million, I'm not walking away with virtually anything, right? Like all the VCs have to be paid back first before I get anything. And normally these deals aren't just, hey, we're going to give you $300 million cold hard cash. It's you're getting acqui-hired and now your equity in the previous company becomes equity in the new startup that acqui-hired you. So now you're still back on the hamster wheel of hoping that the startup that you now have to join. So you go from CEO to being an employee of a new startup that you got acqui-hired at. And then you're still hoping that one day this figurative equity is worth like legitimate dollars. And there are other sides to the VC game as well, right? Like there's been instances where startups and founders, they do find some sort of like private small exits and not really selling all of your shares. But if you were to go raise money for a company and like you get to a point where you can raise at a $500,000 valuation, a lot of the times founders are offered permission or granted permission from the VCs in their rounds to sell a little bit of that equity. So like, let's say you own 30% and you're going to raise at a $500,000 valuation. Sometimes VCs will be like, hey, you can sell 5% of your equity in this current round. So you have a little bit of like a cushion, right? So then there is like a thing of like, okay, well, maybe you can walk away with, 5, 10, however many millions of dollars by selling some of your equity. But it's just important to know that the people that are in those positions to become $500 million companies are so far and few between. And that's why you'll see VCs say, hey, we believe that if we invest in 100 companies and like 1 or 2 of them become major unicorns, they pay back the whole fund and then some. But it's not one of those games where like you raise money and to your point, Ben, you're at the finish line. Raising money almost like opens up an entire can of worms of this new start that you now have to undertake. And to me, if a founder doesn't see this as like a lifelong vision to bring something new into the world or really optimize from an industry that is struggling, it's going to be very hard to like want to go venture and stick with it because the mindset that's needed to build a company that's generational is just absurd.
Yeah, it's a different beast. 110%.
Yeah.
Totally makes sense. For people who are on the outside, I think there's a lot of entrepreneurs that always debate, should I pursue VC money? How much of the company do you typically have to give to get funding from the ground?
So normally in most cases, you're kind of at each funding round, you're giving up anywhere between like 10 and 15%.
Okay.
Depending on how much leverage you have, sometimes you can give up less, but it all depends on like, what are your revenue numbers? What does your traction look like? How much are you growing month over month? That's a very big one. Month over month growth is super important. A lot of startup founders don't pay attention to it. They'll be like, hey, we're making, 16K a month in recurring revenue, but you're not including like churn. You're not including like overall headcount growth if you're trying to scale and grow faster. So month over month growth is probably one of the biggest metrics I look at. And when you're talking about like how much you would dilute, right? Like when we were raising our seed round in 2021, we diluted like I think it was like 14.5%, which to me wasn't bad. It's pretty standard, but it all depends on leverage. I've seen companies dilute as little as like 3 or 5% and raise at crazy valuations, but they had insane leverage to back that up. Versus like if you have little to no leverage, you might be diluting 12% in your first funding round, right?
Mhm.
Like it all depends on where you stand with the investor and how much they think they can get out of you and how much you think you can get back or claw back equity wise. So I would say don't be afraid to dilute 10 to 15% if you really, really need the money and you think that you can make something incredible happen. But the goal is like optimize for the best partners and the best people. Get angels that work in the industry that you are trying to sell into so they can help be kind of your leeway in. Have the right people on your cap table that are going to help you market and distribute and provide like sound advice when you're in moments where you need additional help, because a lot of what venture is people who have already gone through it investing in people who will go through it in the future.
Got it. Makes total sense. So you've already been through this yourself personally. Can you take us through your individual experience and the mistakes that you made along the way, or what you would change if you could do it over?
Yes, for sure. So the first mistake that I think we made as a team was it took us way too long to raise money. Like it was a little bit weird because there was like crypto stuff, and then the legal team we had like not really stalling, but like they were I think a bit too granular on some of the things that we're going through. Like there was like this solicitation thing where like I put out a tweet, not that we were raising money, but something about raising, and they were like, "Oh my god, this is too close to saying you're raising money." So like that completely changed how we had to structure the round, which made everyone have to do a different level of like investor due diligence and took
Wow.
way longer. And then we were chatting with VCs for way too long. Ideally, when you're raising money, you want to like be able to hard sprint it for like a month max and like raise, close, get every check in, and then be able to move forward. Because the longer you raise, that's less time that you're spending with customers and optimizing and building a product that people want to use. So my
Got it.
recommendation would be like try to raise money as quickly as possible. Go in and sprint. Don't make raising your full-time job forever. It just needs to be temporary. And I think that's something we struggle with. And by the time we finished closing our round, um, we were already starting to see signs of like the crypto gaming industry like
Going
slowly
down.
dwindling, right? Like
Mhm.
we closed our round, we started raising, I think it was like October. We didn't close our round until probably I think it was January. Like January is when we closed around and got like our final checks in. And it was just like, yo, what like we lost so much momentum in that period because like we wanted to deploy the capital. Like the goal
Mhm.
of raising money
Just to
is to
use
like
it.
deploy it as quickly as possible so
Yeah.
you can scale up and then continue raising and playing the whole venture game. So I think that from a raise perspective, I would have want to be more, if I had to do it again, I'd be a lot more methodical and fast around raising money. It's like, okay, how much money do we need to just do this thing? Focus on that. And then once you get there, then expand. The next thing I would change is like dissecting the VCs that you work with and really making sure you optimize for the right partner. Because we ended up going with a VC that led the round because they were offering less like a higher valuation and probably a bit more freedom.
Mhm.
But I think the best partner was another VC that had been chatting with us a little bit earlier in the process. And it would have made more sense to just kind of let them lead the round and be more hands on. And who knows, maybe the business would have, still been moving today. because like one of the biggest issues we had was when it was time to like pivot from the crypto Web3 gaming world. I wanted to pivot to something more traditional, but like our lead was more crypto native and they weren't really as excited about pivoting away from like a crypto idea. You know, all these crypto VCs, and nothing wrong with them, but like they're very heavily token incentivized because they're running VC as in like as an alternate operation to how it's actually run.
Yes.
Because they see social tokens and like community tokens as a way to get their equity out a lot faster.
Right away.
What a lot of people don't realize is VC equity is different than token equity. So when you're raising money in your crypto company, a lot of companies in the early stages, they raise on what you call a safe with a token warrant. Safe is equity in the company, but the token warrant is basically like another piece of the business that the VC also is entitled to. So now they get to double dip with equity in your company and your token. But when you launch that token and the VC dumps the token on your entire community, your business is basically cooked, because now who's going to want to put money behind or continue buying your assets or be involved in your crypto protocol after they've been dumped on? And now you've lost all the trust that you've built from your company. So it basically like cripples your company. So for us, it was like, I'm not launching a token unless I really wanted to. So for me, when I look at how we handle the VC like selection process, I don't think I did the best job as a startup founder. And then lastly, I think that myself and my initial like founding team, we didn't always get along, you know, in the best way possible. At the very beginning, when we were building like this very deep crypto business and everyone's hearts were in it, like I think it made a ton more sense because like they were super crypto native. And they were all great guys, like super talented, super bright. But when, you know, we had to pivot the business and start doing other things. I don't think like the synergies align there as much. And we ended up breaking up, and like I basically like paid them to like leave the company, and you know, based on recommendations from our VCs. But what we probably should have done was kind of do the founder breakup thing earlier and see how we could amicably split, because they were great guys and super talented. But I think that once the pivot happened, it was very difficult to like see what the overall future of this business was going to look like working together. And we had our own little riffs, but I still love those guys. I think they're great. It just didn't work out as a founding team. So some of the learnings that I have is just like, you need to go faster. If you think you're going fast enough, you probably aren't moving anywhere quick enough. Like, be quick, be efficient, be methodical. And sometimes you have to be a little bit cutthroat, right? Like, you can't hang around doing any one thing too long if it's not working, if it's not panning out, because what all early stage startups are doing is they are just running and conducting science experiments with money. You're basically saying, if you give me $1 million, here's what I think this outcome can lead to. Let me go take this $1 million and go on an adventure to see how quickly I can make this happen. If they don't make it happen, they die and the experiment ends. If they do make it happen, they're like, okay, that hypothesis worked. We hit product market fit and we have customers now. We need to now go raise more money to start expanding into a larger market. And what a lot of people fail to realize is your initial idea of what your startup is, a lot of the times is not what your company looks like in 24 months if you're growing and you're hyper scaling, because the business starts to build more arms and tentacles. So the biggest things I would say is like just being more methodical, moving fast, and then also hiring. Like, it's so underrated to be able to understand the value that one good hire can bring versus like one bad hire. One good hire can do the job of like 10 to 15 people. And yeah, they might feel a little overworked at times, but like that's because they have the ambition level that directly matches the passion for the business you are building. So I don't think we did an amazing job hiring. Like, I think our employees 1 through 5 were great. But like when we started to try to hire employee 6 and then bring on employee 7, I don't think that like we were as methodical as we needed to be, because like we didn't understand where the business needed to go through the pivots. So really focus like energy on building like a strong company culture. Like, if you look at a company like Ramp today, they have like absurd company culture. Like people see it as a flex to just work there. Once people start seeing your company as like, oh, we're a flex to work here, and like when they do eventually leave, because everyone has their own motivations, you want them to be like, I'm X Ramp, I'm X Meta, I'm X whatever the company is. Because what a lot of founders struggle is like they are way too focused on their own selves to not realize that like everyone has their own motivations,
Totally.
and you can't expect people to want to stay forever. But if you become like the developmental league for the next great startup founder, then you're probably getting operator level work for like a salary, which like is better than what most companies are getting now from their employees. So don't be the guy that's like, oh man, yeah, like I don't want you to ever have any ambitions outside of our company, and you need to be thinking this 24/7. It's like, yeah, when they're on the clock and they're working and like they need to be locked in. If they're locked in and they're crushing it, don't try to stifle their dreams from taking steps beyond you, because it is a bigger advertising flex to have someone have X whatever in their name and then basically saying like, I know this is a stamp of approval and the industry knows it's a stamp of approval, than to be like, oh man, yeah, our employees, they can't do anything, and like we don't want them being able to have their own dreams and visions. So if I ever decide to go back the venture route, I'm not like, if I had to give you a percentage chance, there's like a 5 to 10% chance that like I build another venture backed company unless something insane just comes to mind. But if I ever do, those are the things I would focus very heavily on. So I hope a founder sees this and they realize like, hey, if your valuation 35 mil, chop that shit by like 10, 15%, give VCs better terms and they'll love you more.
Love that. Keith, you had a question, go for it.
Yeah, can we double tap on that culture thing?
Yeah.
Like when it comes to a company like Ramp, what is it about Ramp that you think builds that kind of culture?
I think that the founder, his name is Eric Glyman. And from what I've heard, from the people I've chatted with, he's very emotionally intelligent, very compassionate, and he's one of those people that just focuses on building up people. There are founders that focus on outcomes that don't directly lead and correlate to like building people up. And a lot of times, like that stuff is obvious, right? Like as a founder, when you're doing that, your team can see it, they can feel it. And I think of building a company as when you're a CEO, you are basically like the adult and you have a bunch of kids in the room. A lot of times these kids are 20 times smarter than you, and you want them to be 20 times smarter than you. But you have to lead by example. If they see you doing a bunch of BS, they're going to do a bunch of BS. My fiance was saying this the other day. She worked at this health and wellness and beauty startup here out of Miami. And she was saying that like sometimes the CEO would show up late. She would show up, looking unprofessional clothing, all these different things, right? And that resonated with me because it's like whatever your employees see you doing, they are going to do. You're showing up 5 minutes late. It might not seem like anything in the grand scheme of it, of like whatever in the moment, but that turns into employees showing up 5 minutes late. Then it's 10 minutes late. Then it's some of them aren't showing up altogether. So you have to truly lead by example in the culture that you want to build. But it can't just be, oh, let me be so stringent that I'm a jackass, but like give people room to grow and flourish, right? Like some of the best CEOs, they just get the hell out the way. Your job is to run the ship and plug people in places where they can be optimized the same way a coach would on a football field, right? Totally. Like you really think Andy Reid is out there telling Pat Mahomes like, bro, you need to make sure you hit this slant route instead of throwing the fly, hit the slant? No, because there's so many inputs and outputs happening on the field. They're like, you're the expert. I'm going to just put you in a position where you can go out and be successful at the thing that you do best. And if you can put people in position to be successful and provide them with an upward trajectory, you're going to retain so many employees that you won't have any problems as a CEO.
No, I think that's so good. And I think that that's something that also hiring really matters too, because you can't really lead the way that you want to unless you nail hiring. But I know you got to jump in a minute here. So can you answer these 2 questions rapid fire here?
Yeah, for sure.
So I'm behind in the video trying to catch up, but can you share your perspective regarding safe notes, QSBS, I've never even heard of that, relevance in VC, and compensating yourself as a founder?
I don't know what the QSBS term is. So like if someone can figure that out, let me know.
It's qualified small business stock. And it's an exemption that you get for investing in a small business that when you get the exit, you don't pay taxes on the exit. I think it's like up to $10 million that you can invest. It's a US based.
Oh, that's interesting. I'd never heard about that before. So like I would have to do a bit more research before I like deeply comment on it. But what I will say is when I was building my startup and we raised 4.5 mil, I pay myself like 120K a year. I think that like you need to pay yourself depending on like where you live. Pay yourself well. Like don't pay yourself like a salary that's like so absurd.
You can't survive.
Like, yeah, you can't be like I'm a seed stage startup and I'm paying myself 200K, right? 1 second.
You're good.
I just had to sneeze, but
You're good.
you don't want to pay yourself like a crazy amount of money because it's like, yeah, you're getting funded to build this thing, but like, bro, you got to survive. The company dies out because you want a 200K salary and you're driving a $70,000 BMW, then like, we know whose fault that is.
Totally.
But I like safe notes. I think safe notes are a great way to launch your startup without having to deal with all the deep legal paperwork that happens. And I mean, you can, dude, I remember like Mercury Bank, which is a startup bank, dude, I invested on a safe where literally the founder just like sent me the safe. You like literally just put in the amount that the valuation is and however much you want to invest and you sign it and it's done. Like it's not even like that deep. Eventually though, you will have to do a price round, but if you get to that point, that means you're actually doing something well.
What about having your personal net worth tied to the company? That was the next question that they had.
Yeah.
Previously, I had my personal net worth tied to the company in terms of like I didn't have my equity under any like shell company. I would say it depends and it varies. If you only have one company, like no one wants to get sued for something. So like if you have the means to just put together some sort of shell corp, go for it. I've recently done that. Like I incorporated kind of like a shell corp in Wyoming. And like now I'm like in the process of like moving all of my businesses under the shell and like doing that whole thing because overall it is better. And then like as your businesses start making money, you just pay yourself a salary so you don't get fucking hemmed on taxes. Because this past year and this coming year, I know I got actually like dog destroyed on taxes. So I like the idea of like putting equity in shell companies and leveraging kind of the tax codes and the legal ramifications that exist to put yourself in a better taxable situation. There was I can't remember the guy from like a very successful startup. He actually put his startup equity in his Roth IRA because when he first set up the startup, it wasn't worth anything. Like startup equity is like pennies on the dollar. Now the startup, I don't know if it was Stripe. It was one of those really fucking big companies. Now the startup is worth like absurd money and it's all going to be tax-free because at the time of him putting it in his Roth IRA, he was only making like maybe 30, 40K to qualify for the Roth, which is like, you can pay taxes on it at that moment. Wow. So you don't have to pay taxes on it later. So because his equity was worth cents on the dollar at that moment, and now it's worth, I don't know, maybe it's worth $1 billion. I got to find the story.
This is Peter Thiel. I don't know if maybe you're someone else, but Peter Thiel is the prime example of that. It was PayPal. It might have been Peter Thiel. It might have been PayPal instead of Stripe. But to me, that was a crazy ass idea. I personally don't think like, I'm not trying to wait like till I'm 55 or 50 to see my bread. I ain't gonna hold you, but I thought that was a crazy good idea.
That's crazy, man. That's crazy. Well, Bryce, we appreciate having you here. I know you got to jump, man. So we appreciate you so much. Everyone who's watching this, every one of his socials is linked down below. Go show him some love. Go give him a follow and get more of this.
I appreciate you guys having me, bro. It was a blessing to be here. Nice to meet you, Keith. Ben, you've been crushing it. I know we've been trying to get this one in, so I'm glad we locked it in. But that's it. Definitely want to get back on in a couple of months, and we'll see where I'm at.
Hell yeah, man. Can't wait.
Come back, man, for sure.
Awesome. Take care,
Bryce.
guys.
Thank you, buddy. Bye-bye.
Yep. Peace.
Sweet.
Fantastic.
Keith, now we're here. Chat, now we're here. Do you have any questions that we can answer?
Yeah, what up, chat? What y'all think of Bryce? What y'all think?
Bryce is a legend. Great energy. Super cool story. I also think one of the things there's so many things that I wanted to talk to him about, but I knew he had a heart out. Yeah. So I was trying to be deliberate with the packaging and the promise of the content. But he also is a great example of you're never stuck, right? Pivoting is a lifelong pursuit. And sometimes it's the right thing to do. It's not a failure to pivot. Sometimes it's just the right thing to do. And I spoke to him, I want to say 5 or 6 months ago, and he had barely even started on this journey. And now he's one of the most famous figures in all of venture capital. He achieved that in like 6 months. That's pretty remarkable. And that's actually what's possible if you blend your unique experiences with a unique opportunity.
Yeah. And like to the ethos of the whole conversation, if you ever listen to the people at Y Combinator, Gary Tan, and any of the other fellas there, like one of the main topics that they actually talk about in venture and in that world is the importance of the pivot. Mm-hmm. Like pretty much every single company that's gonna raise money and go through that, like they're gonna pivot. So the most famous companies that we see today have gone through some form of a pivot. And so all in the ethos of venture capital and startups and all that, it's literally a part of the process. But even as an individual, right? Like this is how you have to look at your life. And like Bryce was saying, you know, being able to get comfortable through those things, or finding ways to navigate those things when you have other people involved as well. It's like that is going to be the thing that really determines your success. I mean, this is life, right? It's pivots.
It's all expedited learning. I think that's one of the core things that we talk about on the show so much, because it's so damn true. Like if you can convince yourself that a failure is a lesson and not a failure, that's like the cheat code. Like the amount of time, and you just start getting excited by how many times you can fail. I'm not saying fail for failing's sake, right? But don't let it destroy you. I think a lot of people have failed once and they're still crying about the failure when they could have been a winner already. So I think that's an amazing opportunity, and with all the tools that he talked about, right? So I want to dive a little deeper for the aspiring entrepreneur, right? Because I think most of you guys watching this, you probably shouldn't go get VC money. So I now want to help you in terms of like, how do you get to a place where maybe one day you want VC money? I don't think you should try to make that your goal if you're a first-time founder. I really don't. I think that you should bootstrap something and try to validate an idea and see how hard it is to run a business, because a lot of people are very ignorant to what running a business really means. They think it's one lane of the business. And I've seen this even happen where I was working with a buddy of mine's brother who ran a design agency, and he was one of the best performers at an existing design agency. And so he went on his own to run his own shop, but he had never run his own shop before. And so he thought it was just delivering on the designs, but it's like, buddy, there were 10 things that happened before you got the work to design in the first place. And so he was a bad business owner at first, right? He had to learn. And so then I was one of his guinea pigs, one of his first customers. And so it was a really bad experience. So I think a lot of entrepreneurs really don't realize the totality of running a business. What would you add on to that, Keith?
Well, I mean, this came up really well in our conversation with Hunter Isaacson too, right? Like this concept of you can raise all this money for your business, but you've never had that money before,
Yes,
right?
yes,
So
yes,
all
yes.
of a sudden you're
What does it
supposed to
mean?
be capable of deploying this money and like managing a business that has that kind of money in its bank account. Like probably not. So yeah, I think it's a really important point to like, and his whole thing was like, if you work up to that point to where you have that kind of cash, then you know what it takes to administer that cash, and you
Yeah.
know how to grow the company from that place, right? Rather than I don't have any money and I'm just trying to raise money to start something new.
Yeah, you just because you have the money doesn't mean you're the person who had the skills to do it themselves. And I think there are massive differences. The qualities are really what we're going after. And I think that's also why Bryce had said that if you failed once, VCs are actually more likely to back you, because you've paid the lessons on somebody else's dime. And I also think that like for Bryce, another example that you can take from him in particular is the fact that he's really open and honest. Right. Like in so much so, right? Like we're talking about VC. He's the VC guy, and he's literally saying you guys probably shouldn't pursue VC. Like I love people like that. Do you know what I'm saying? Like just give it to me honest. You know what I'm saying? And that's why I think deals will come to him in a very big way, because I'm sure there are people who will eventually watch this that are maybe 5-10 years down the line. They'll want to work with his VC firm, right? Because he wasn't full of shit.
100%. I mean, literally, I imagine that level of trust that you gain with someone from just being honest like that would make me want to go to you to give me money, right? Because now I can actually trust you.
100%. That was really my issue with a lot of other VC firms, is that it doesn't feel like they're as much like that. And I think that's also a byproduct of growth. It becomes really hard to be transparent when the people who are making the decisions don't even see the decisions, right? Because eventually, like, there's so many people involved. And that's really what I noticed working with these VC firms, is it was very high strung. Like everyone who worked there was like on edge 24/7. And there were so many people working there that I had to speak to 20 people to make one decision, right? And so that's just something that you also have to understand what you're getting yourself into. And I think the fact that there are creators like Bryce showing you behind the scenes to what was previously a pretty untouchable world. The other question that I wanted to ask him really badly was, how do you go from 0 to 1? Right? Because it is kind of like an echo chamber of the VC world, where either you're born in that kind of world, you have friends in there, or you have a lot of money. But if you're me, right? If I'm a dude from a medium town in Canada, how the hell do I start getting funding? That's what I wanted to ask him, but we ran out of time. So I'll have to get him back.
Yeah, I mean, there's so many different things we could have asked him about, and so yeah, we'll definitely have to have him back.
Totally. But open up the chat here. We got just watched The Big Short and just tuned into the stream. Have y'all covered the so-called housing bubble? And you think real estate contracts come to be tokenized soon? So yes, I do think that real estate contracts will be tokenized, or like NFTs, some sort of blockchain asset. I think it just makes more sense. It can achieve basically what's being achieved now in a superior way. So I think it's an inevitable reality. How about you, Keith?
Yeah. there's so many reasons why you tokenize the contract, maybe the deeds,
Yes.
okay, to properties. This is an issue globally, is why I say that too. South Africa in particular now has been going through this whole issue where the records, and this probably happens all over the world, but the records to land ownership are just being altered, right, by corrupt politicians in a local government, right? Like, think about how corrupt your local government can be.
Oh my
right? There's no
goodness.
accountability.
Yeah. Crazy.
So, when your legal structure is not strong, you can literally just change the history of who owns what, and that's not a world
Not
that
something
you
you
want to
want.
live in.
No.
So anyways, that's actually something that, for so many different reasons, there's a lot of inefficiencies. There's a lot of rent-seeking behavior in any financial service business. What do real estate agents really do? You know what I mean? Like, they're connectors and they get paid. They should get paid for what they do. But from the consumer's perspective, do I really need one? Rather, it's the
No.
question. Yeah.
I worked in real estate, and they tried to sell me on becoming a real estate agent, and I was like, nope, I'm not doing this. But to the second part of your point, Victor, where the so-called housing bubble, I don't think that bubbles in that kind of market will pop again, because I don't think the governments will let it. So I do think that two things can be true. Like, it can be a bubble, but one they won't let pop. I think the prices are obviously dramatically inflated. I saw this firsthand from watching the market. You guys were there's a little later on the crazy house gains. We never stopped. Like, we've been consistent like that.
Yeah.
Producer Kurt and I have talked about this so many times, where it's just a different world here. But you guys got crazy over the last 5 years or so to like unsustainable levels. So it'll definitely chill. I don't think it'll crash ever again, because the cascading effects of that happening, I don't think you guys could recover from that. So I don't think they'll let you fall.
Yeah, I mean, the whole propping up of the financial system in general, it's all done through mortgage-backed securities and essentially supporting, the housing market in that regard. A lot of it's done that way, rather. And so, I mean, we're definitely having a crunch outside of the residential housing markets. We've
Oh my
got
goodness.
the bankruptcy rates, or the delinquency rates, rather, for office buildings going through the roof at the moment.
Which only makes
And
sense.
yeah, and I think because it's not so systemically important, that sector could absolutely get crushed,
I agree.
and maybe take the fall for the rest of the real
Yeah.
estate market that otherwise would
Great point.
also need to go through something
Yeah,
like that.
they can only prop it up so much. The natural state of a market that's that inflated, I think, would need to come down when the purchasing power of the genuine customers aren't. But you also have to remember that a lot of the purchasers of these assets aren't you and me. So although it may be out of the price range for you and me, BlackRock doesn't give a shit. Right.
Yeah,
And so,
for sure.
yeah, it'll be interesting to see what they let happen. But Cross Central also said midnight got me geeked out, the midnight drop. So anybody who had eligibility for the drop, that is now live. And Keith, this got me fired up. As a Cardano native token, it is sitting at a $1.1 billion market cap. That is massive for the Cardano
Wow, that's
ecosystem.
top 100,
Yeah.
right?
That's so big for Cardano. So it's saying it's got to be updated, because it's currently saying it's 204, but I don't think there's that many projects that are over $1 billion, are there?
No, not maybe, unless you're talking difference between fully diluted versus
that may be the issue.
Okay, fair.
But still, for anything, because if you've looked into the Cardano ecosystem, which I strongly recommend doing, like, the things on there have just been beaten up. If you look at their comparables on other chains, like, they're, in my opinion, mispriced. And I think that this will probably be one of the first things that wakes people up to that reality, because everyone is now forced to go over to look at Cardano, which everyone's been told is a dead chain and doesn't do anything. And I think that more and more people are going to start doing these things if they can get marketing right, if Charles can figure out the messaging piece, and they can attract even a few amazing builders, I think they can win. But we'll see. Victor says, yeah, that makes sense. And yes, I agree. I'd love to live in a 20K square foot office someday. That'd be sweet, eh? Your new rent is the old Facebook building or whatever. What's up, guys? Just tuned in, 5 a.m. right now. What's up, thoughts of a man? Go ahead, Keith.
Yeah, it was good. What's good? That's awesome to wake up and join us. We really appreciate that. That's so cool.
Yeah, you're a legend. We appreciate having you here.
On the office thing, like I actually wonder, this is taking a really long time to play out. Like 2020 was when it started, right? We're talking 5 years later, they're still somehow not like completely, yeah, like I imagine this would have blown up a while ago.
I think that speaks to the profitability of a lot of the companies who are doing this shit, right? Like their profit margins are just like historic levels high, where
That's fair.
they can weather it.
Yeah, we should definitely, man, we got to have some more experts on in that space. And I know you have that lined up because there's the residential side, but there's also that office side. And I think there's a lot of insights that you can get from the office side. So it also tells us about the trends of what businesses are doing. And like, that's just a part of the real estate market too, that I think, it just tells you so much more about what's happening in culture.
Totally.
Anyways.
Yeah, no.
So
go ahead,
sorry.
You're good. You're good. Go for it, man.
I don't think I have anything to say, actually. So
okay, I was just gonna say, yeah, we do have a guy coming on for the residential market. I don't know how well versed he is in commercial, so we may have to bring on a different expert for that. But yeah, if y'all are here, make sure to like the stream, subscribe to the channel. It helps us all grow so much, so we appreciate you tremendously. And if you guys have any topics that you want us to talk about before we get into the news, speak up now, and we will do that for you.
Yeah.
But Bryce is awesome, to bring it back to the core point. He's awesome. If you're interested in the VC world whatsoever, go follow him. And I also think how we've talked about this a bunch too, Keith, where the world opens when you start making content. And if you pick the right lane, you can get in so many rooms, right? I picked social media because I realized every person I looked up to was going to need social media. That's why I was an 18-year-old kid or 20-year-old kid, whatever. And I decided I'm going to be this guy, right? Bryce just sprinted to being that guy in like 6-7 months because he saw a lane and he was able to compound on his previous things. Go ahead, Keith.
Yeah, it's just that leverage thing. Like I think people really sleep on like the leverage that you can get, because here's the thing. You get to choose what it is that you're going to talk about. Okay. So for someone like Bryce, who was chosen to go into like one of the highest leverage / highest value topics that you could possibly have, right? Venture capital, okay, fundraising, okay, and capital deployment. You can put out an hour-long video, 2-hour-long video, get 10 views, and you've raised $1 million for getting 10 views.
Yes. Who's watching matters.
100%. So don't sleep on that when we continue to have all these conversations about the importance of media. Because we've got access to these tools that allow you to do stuff like that allow you to hyper target and find the people that are exactly perfect for what it is that you want to talk about.
And there is an audience for everything. We've talked about this recurring thing where people are obsessed with themselves, and that transfers over to their professional life too. So there is a market, and if you're a creative marketer or entrepreneur, you can turn not a lot of traffic into a ton of money if you're smart with it, right? Which is just such a massive thing where I was running my YouTube agency and working with very small channels that were making millions of dollars from their YouTube channel, right? Where other companies would have been like, they wouldn't have even believed me, right? Like the value of traffic is something that I have been aware of for a long time because I've been in the space, but you got to not believe the propaganda of short form virality is the move. Not only is it harder to get short form virality, turning that into cash, incredibly difficult. Right? I think people are even learning that in the VC world, right? Like the whole Cluely shit, how their whole thing was like, we're going to be so viral. They've already pivoted multiple times because that doesn't convert to cash. And also, when something goes viral, it's reaching people who have no money. Right?
Yeah.
It's not even a good thing, honestly, dude. Because like, obviously, I want everyone to be affluent, but people who don't have money, they can't help you make money. So I think most young entrepreneurs, the biggest mistake they make is trying to sell to themselves. If you are poor, yourself can't buy.
That's a very good point.
And I made that mistake too. Yeah. I'm like, oh, I'm going to build a clothing brand for me. It's like, I have $40 in my bank account. I like when I was in college, right? Like I'm not spending $50 on a t-shirt. That was dumb. But sometimes you got to learn. You can also fast track this from actually listening to what people say. I think young people, they have this wall where they just think everyone's full of shit. And I was there too, right? Where if you just listen to someone, you don't actually have to pay the cost. If you can acquire the skill of genuinely like feeling the feeling state of the lesson that's being shared with you, You don't have to waste the time and pain to go through it yourself. So how would you, so we got this request for an update here, or can you guys give a quick update on today so far? Do you mean like today's episode? I'm assuming that's what he means.
Yeah, I think so.
We talked VC, so venture capital. So if you've ever wanted to start a business, you need money to run the business. We brought on Bryce, who is an expert in all that stuff. So I recommend going back, rewatching it. If you have any questions, all that, that'd be awesome. So Ben, is the idea behind monetizing low volume traffic, is it that it drives viewers to a profitable funnel? So the nuance here is, I'm not just saying like you shouldn't go for views. I'm saying that if you don't go for a lot of views, but the views there have an obvious high ticket conversion opportunity off of it, then that's what I'm saying, right? So like, let's say you are promoting an offer that maybe is only for 1,000 people on the planet, maybe, right? But you make a search-based video that reaches those people when they search. If they convert and you can get 10% on something that's thousands and thousands of dollars, those 100 views are worth way more than that idiot who like did crazy stuff to go viral on TikTok, right? I think a lot of people, they are sold the wrong version of what being a content creator should really be. I think that I'm more of an advocate of the whole Gary Vee approach to content creation, where it should be a vehicle to grow something you're passionate about rather than just the whole business for most people, right? Whereas most people are so obsessed with the views, and that's a dumb game to play in my personal opinion. I think the views are actually a vehicle to money. And I think even the people who are trying to get the views, if you ask them why they want the views, they'll say they want to get rich versus getting ad revenue. Yeah, ad revenue is this bullshit. Like, you will never get rich from ad revenue. 99% of people, like legit.
Mr. Beast is the only guy.
But even him, with what he's spending on his videos, I doubt he's breaking even on that. I bet you his money comes from the businesses. Dude, have you seen what he spends on videos, dude? He literally builds full-on movie sets for a YouTube video.
Bro, he's got to be making like 9 figures off of just the ad revenue, though.
Probably, but he also spends, like, his overhead is crazy, Keith. His team is like hundreds and hundreds of killers. They literally build full-on sets. Yeah, so they're probably close to breaking even, which is also a cheat code because they can use that to keep funneling more and more media and attention into the other businesses, which is obviously a cheat code. And that's also why the guy that he brought up, Jeffrey Wu, I can't remember his exact name, but he's one of the most public VC guys, and he partnered with Jake Paul on their whole W thing. Have you seen that brand? That was a genius brand. I think that will do well.
And yeah, Victor Torres, seriously, that would be super sick to see Mr. Beast P&L. The Beast. So while I've been here in Bangkok, I went to the mall one day and I saw this like Feastables pop up in the mall. And I was like,
in Bangkok?
In Bangkok?
These guys are everywhere.
That's crazy. That's the scale of these kinds of businesses. Like if it's in a little tiny little kiosk in the mall and it was a pop-up right in Bangkok, then like that dude's everywhere then.
He really is. Yeah, he's definitely reached mainstream for sure, but you don't need to build the life that you want by doing that. Is kind of my whole point, right? There are so many pockets that are just being left because everyone's chasing these massive views, and so then they actually shape their decisions around niches and video topics that can get those views because they think the views is the solution, and it's just really not. Should we get into the news?
Yeah, man, we can dive into some news real quick. First things first, if you didn't see it, you're about to. And this is that in the United States of America, we have banks now officially allowed to buy and sell Bitcoin and cryptocurrency for their customers. This was an interpretive letter issued by the Office of the Comptroller of the Currency, which is essentially the regulator of money, of actual money in the United States. It's a sub office of the US Treasury. So this right here is pretty cool.
Huge.
They're calling it riskless principal transactions, which basically just means that there's no the bank is not taking the other side of the trade. They're not acting as like a broker dealer, but rather just as an agent essentially for the transaction, is what I understand that as. So anyways, that's huge. Obviously all week we've had banks coming out and saying, oh, we're gonna we're going to allow crypto, and same thing for stuff about the ETFs and Vanguard and all that. And yeah, Victor, it's one of those moments. I have a video tomorrow coming out about the Clarity Act. And the whole thing is that this whole year we've had the SEC, the CFTC, the FDIC, the OCC, I don't know about the FDIC, whatever, all issuing continued interpretive letters around what banks can do. Now, the thing is that that's fantastic because it does give the green light. It says that it is okay for these banks to do that. Now, the problem is that these interpretive letters they're not law. Okay. So it's just guidance from regulators. So once we get the Clarity Act in place and you have every single agency that's thought about all the 100 different ways in which that these companies can interact with Bitcoin and crypto, you've got that already there. So that now when the laws pass, it's like, okay, you legit have full green light, can do anything that you want that is within the guidelines of the regulations. So yeah, I just wanted to point that out because it's fantastic to get these updates, but it doesn't fully come into effect until we get the laws passed. And the fact that we have these interpretive letters in place, though, means that when the laws do pass, that you've really got full reins to
it's go time.
Yeah, you're good. So anyways, move on. We had Bitwise this week has gotten through something that is technically revolutionary for the space, because they've launched a new ETF that is essentially an index of the following 10 digital assets as an ETF. So you have Bitcoin, Ethereum, XRP, Solana, Chainlink, Litecoin, Cardano, Avalanche, Sui, and Polkadot all in one ETF. This is one of the first ETFs that's by a major crypto asset manager to include Cardano, Avalanche, Sui, and Polkadot.
That's big.
Yeah, man. So, they're obviously toting this all over social media. They're very excited about it. This whole ETF push, I think, is crazy.
Yeah.
And now we have an actual index. And I think Bitwise is well positioned to actually be the index of the industry.
Yeah. No, I think that's going to do wonders for bringing people in, because I think that we've talked about so many times where once people's money guys say, oh, we can do this and we should do this, they're just going to do it. And then they're going to make a lot of money, and then they're going to become curious and then become educated. So yeah, all this stuff is super huge for bringing things to people who would never have normally seen crypto or be okay with crypto. But when people make money from something, they like it.
100%. This one is a little bit off of our path as far as crypto, but I found this to be very interesting regarding the media and culture side of things. So apparently the U.S. Customs and Border Patrol, or whatever it's called, Customs and Border something, has basically released some sort of an idea where they could start asking foreign tourists for 5 years of social media history before they let them into the country.
That's crazy. What does that even mean? That's absurd. What does that even mean?
Yeah, so the real question is, like, what is it exactly that they're looking for? And somebody dropped a really funny meme. So let me pull that up real quick. It's a picture of Trump and Marco Rubio. Is Marco, don't let them in unless they post thank me.
Honestly, that could be a good policy. But no, that's crazy. It seems like more and more of that's coming in, where they're pushing for things like this, digital identity, all these things where they'll pitch it as the solution to our problems or safety, all these things. They always do, right? And then is it really safety, or is it giving up liberties that we didn't have to give up in the first place?
Yeah, I mean, the UK has been taking the charge on all that, right? Like,
that shit seemed crazy from an outsider. I'm not there, so I can't speak to if it's real or not, but it seems crazy.
There was some stat about how the UK has had more arrests due to social media incidents than like Russia. I'm going to try to find it because I mean, at that point I was like, okay, that's pretty wild. Anyways, so moving on a little bit, I just basically had another couple of memes. We had the president made a statement on Politico, the president of the United States, to be clear. and there was a funny meme around it. So hold on.
Pretty good.
But I do want to talk about the economy, sir, here at home, and I wonder what grade you would give
A
your
plus.
economy.
A plus 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 plus.
Well, it's interesting,
Pretty good.
but I do want.
So he's giving the U.S. economy an A plus 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 plus.
That's awesome. I wish he was my teacher, man.
Yeah, right. Can I get that? And so this guy said, grading the economy like, yeah, changing that F into an A plus 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 plus. Anyways, and then I thought this was really good. I was going to try to bring this up with Bryce, but I think I will have to catch him on another meme next time. But I saw this one really quickly. It said, "Sell me this pen." Guy says, "It's AI powered."
There you go. That's awesome.
Yeah,
great meme,
so,
dude.
I think that's a lot of people there. 300 views. Sorry, I saw that.
You're good. You're good. That's all good stuff, man.
So
You're getting a phone call. Buddy.
Yeah, don't. If you're watching this, don't call me.
Don't they know you're streaming?
Yeah, like come on. So yeah, so this fly Thai guy said, I have friends that live in the UK and it's real. Unfortunately, they have taken the lead on taking away your freedoms. Yeah, that's a tough one.
I like the UK. I visited there quite a bit and I always liked it a lot. So that's sad to hear if that's actually taking place. But yeah, man, it's things are probably gonna get crazier before they get better. But I would buy that pen. Been talking to Grok a lot about the markets. So Victor wants an AI pen. That's fair. Anything else you got for the people, Keith?
I'm feeling pretty satisfied. I think this is awesome.
Sweet.
Awesome time spent.
That's it. That's it. Well, so now is your last chance to ask any questions or bring up any topics before we wrap up and let Keith get to his evening there. But we appreciate you tuning in as always. I'm gonna ask one more time, smash the subscribe button or tap it lightly, caress it, whatever you're into. I don't judge.
Caress that thing.
And turn on notifications because we safeguard your notifications. Unlike other channels, we only post live streams here. So all the clips are elsewhere. You will not get bombarded with notifications. Only the good stuff. Turn on the noties. Let's go.
Come on now. Just like that.
Do it now. But we appreciate having you here. Honestly, you guys are all awesome. We love you a lot. A latte. And it's so fun chopping it up with you guys. We have another guest tomorrow who is Keith's homie, who is a young entrepreneur, very involved in building things with AI. So if you've thought maybe, hey, maybe AI is my route to entrepreneurship, tomorrow's conversation might be for you.
You gotta pull up. You gotta. Yeah, he's awesome. He's actually really fun. He's gonna fit right in with the culture of everybody here. So be sure to join. He's a killer.
Sweet. Well, if y'all are gonna be quiet there, then we're gonna wrap up the stream here, I think.
Yeah, y'all been so quiet today.
What's up with that? I know there's a lot of learning going on, but you guys gotta, when we have guests on here, you gotta talk to them. You know what I mean?
Yeah. Like it's like when you have a guest lecture in the class and no one asks the question.
Questions.
Come on,
yes.
bro.
I was always the kid who would ask questions. Even though I didn't fucking have one, I'd be like, I gotta come up with something. You know what I mean? And then I would ask something. And yeah, we need that from you guys too. Also, you benefit more. If you have any questions, throw them in. But we appreciate all y'all for tuning in. As always, thank you so much. We'll see all of you guys tomorrow at 12 p.m. EST. And that's all from me, Keith. How about you?
That's it. We appreciate y'all so very greatly.
Sweet. On behalf of myself, Keith, and producer Kurt from Memes and Markets, we appreciate y'all. We'll see you tomorrow.
Let's go. Peace.
Peace.
Dude, I keep on fucking forgetting to